Chapter 1: The Retail Trap: Why Your Indicators Are Failing You. The retail trading floor is a landscape littered with the ghosts of perfect setups. You've likely seen the maps they give you: a colorful array of relative strength index lines, Bollinger Bands, and the ubiquitous head and shoulders patterns. For decades, the narrative has been that if you simply master these retail geometries, you can outsmart the market. Yet, the statistics tell a grimmer story. There is a reason the 90-90-90 rule persists. 90% of retail traders lose 90% of their money within the first 90 days. This isn't a failure of individual discipline or a lack of chart time. It is the inevitable result of playing a game with a playbook written by the house. To win, you must first acknowledge that the market does not move because a moving average crossed a line or because a stochastic oscillator entered an oversold zone. Prices move because of a massive imbalance between supply and demand, orchestrated by the central banks and institutional behemoths that control the world's capital. These entities, the smart money, do not look at the market through the lens of retail indicators. They view the market as a pool of liquidity, a vast ocean where they must find enough opposing orders to fill their billion-dollar positions. While retail traders are taught to place their stop losses in predictable clusters, the institutions see those clusters as fuel for their next major move. Success in this arena requires a radical shift in perspective. You must stop trying to beat the institutions and start learning to shadow them. Smart Money Concepts, SMC, isn't just another strategy. It is a forensic study of market intent. It is about identifying the footprints left by big money before the move happens. When you stop looking at the market as a series of shapes and start seeing it as a hunt for liquidity, the random spikes that used to wipe out your account suddenly become predictable entries. You are no longer the prey caught in the retail rabbit hole. You are an observer of the trap, waiting to ride the momentum of the hunters. Chapter 2: The Giants on the Field: Who Moves the Market. In the vast, interconnected ecosystem of global finance, there is a distinct hierarchy of power that dictates the rhythm of the markets. At the absolute apex sit the central banks, the architects of monetary policy who possess the unique ability to shift entire economies with a single interest rate decision or a change in reserve requirements. Below them are the Tier 1 commercial banks, institutions like JP Morgan and Goldman Sachs, whose trading desks handle trillions of dollars in daily flow. These are the titans of the tape. They do not merely participate in the market, they are the market. Their footsteps are so heavy that every move they make sends ripples through the charts, creating the trends that retail traders often chase but rarely understand. Understanding the smart money begins with recognizing that these entities do not operate with the same constraints as the average home-based trader. While a retail participant can enter and exit a position with a simple click, the sheer scale of institutional capital creates a logistical challenge. When a major hedge fund or a commercial bank decides to build a position worth billions, they cannot simply hit buy without spiking the price against themselves. They require massive pools of liquidity to absorb their orders without causing immediate, unfavorable slippage. This necessity is the primary driver of market behavior. For the smart money to enter, they must find enough counterparty interest to fill the other side of their trade. This dynamic creates a predator-prey relationship often invisible to the untrained eye. To fill their massive buy orders, institutional players often need to see a surge of selling pressure. Conversely, to exit a large long position, they require a wave of buyers. This is why smart money movements often appear counterintuitive to the novice. You will frequently see price drive aggressively into a support level, triggering the stop losses of retail traders, only for the market to reverse violently in the opposite direction. What the retail world perceives as a breakout or a crash is often these titans engineering liquidity, using the forced exits of smaller players to fuel their own massive entries. To master the smart money playbook, you must stop viewing the market as a collection of random ticks and start seeing it as a hunt for liquidity. These institutions operate with sophisticated algorithms designed to seek out pockets of orders where they can execute their business with minimal friction. They are the whales of the ocean, and while they cannot hide their presence entirely, They move with a calculated precision that leaves a distinct footprint on the tape. By deconstructing their motivations and identifying where they are likely to do business, we move from being the liquidity they consume to the shadows that follow in their wake. Chapter 3: Market Structure: Deciphering the Financial Matrix. To the untrained eye, a price chart is a chaotic sequence of jagged lines, a heartbeat monitor of global anxiety and greed. Most retail traders attempt to tame this chaos with diagonal trend lines, hoping that a thin stroke of a digital pen can contain the momentum of billions of dollars. But market structure is not about drawing lines. It is about reading the tectonic shifts of institutional order flow. To master the smart money playbook, you must stop looking at price as a series of movements and start seeing it as a logical sequence of breaks and holds. This is the anatomy of the market, the skeletal framework upon which every profitable trade is built. The foundation of this framework rests on the relationship between swing highs and swing lows. In a bullish market structure, price behaves like an ascending staircase, consistently creating higher highs, HH, followed by higher lows, HL. This isn't just a visual pattern. It is a signal that the smart money is stepping in to protect their positions at higher price points, refusing to let the market dip below previous areas of accumulation. Conversely, a bearish structure is a systematic descent of lower low and lower highs, LH, where every attempt at a rally is met with a wall of institutional selling that forces price to new depths. The professional lens requires you to move beyond the superficial up or down analysis and identify the specific point where the narrative shifts. This is often found in the transition between a ranging market, where price is trapped in a horizontal tug-of-war, and a trending market. While retail traders get chopped up in the noise of a range, the sophisticated trader waits for the structural break. Understanding market structure means knowing that a trend is technically intact until a key swing low is violated or a vital swing high is breached. Once you can accurately map these pivot points, you stop guessing where the market might go and start following where the money is actually moving. Chapter 4: The Footprint: Identifying High Probability Order Blocks. In the world of institutional trading, the market doesn't speak in whispers, it speaks in structures. To the untrained eye, a price chart is a chaotic zigzag of candles, but to the professional, it is a rhythmic sequence of highs and lows that dictate the path of least resistance. At the heart of this rhythm are two foundational concepts that separate the amateurs from the masters: break of structure, BOS, and change of character, CHOCH. Understanding the distinction between these two is the difference between riding a profitable wave and getting caught in a shoreline undertow. A break of structure, BOS, is the market's way of saying business as usual. In a bullish trend, a BOS occurs when price successfully punches through a previous swing high, confirming that the bulls are still in control and the momentum is intact. It is a sign of trend continuation, a signal that the supply at that level has been consumed and the path is clear for higher ground. When you see a BOS, you aren't looking for a reversal, you are looking for the next pullback to rejoin the existing flow. It is the heartbeat of a trending market, reinforcing the direction you should be trading. However, the market is a living organism, and trends eventually tire. This is where change of character, CHOCH, enters the playbook. A CHOCH is the first warning sign that the dominant trend is losing its grip. It occurs when price fails to respect the previous structural low in an uptrend or high in a downtrend and breaks through it, signaling a fundamental shift in market sentiment. While a BOS signifies a continuation of the old story, a CHOCH is the opening sentence of a new one. It represents the aggressive entry of big players who are no longer interested in pushing the price further in the current direction. Learning the language of BOS and CHOCH allows you to stop guessing where the market might go and start reacting to what it is actually doing. By identifying a CHOCH early, you avoid the common trap of buying the dip on a trend that has already died. Conversely, by recognizing a BOS, you maintain the discipline to stay positioned in a winning trade rather than exiting too early out of fear. These aren't just technical patterns, they are the footprints of institutional money, showing you exactly when the tide is coming in and exactly when it's time to head for higher ground. Chapter 5. Mind the Gap. Fair value gaps and market inefficiency. In the world of high-stakes trading, liquidity is the invisible oxygen that keeps the heart of the market beating. Retail traders often view a price chart as a series of random zigzags and patterns. But to a financial institution managing billions of dollars, the chart is a map of supply and demand. For an institutional player, the primary challenge isn't just predicting where the price will go. It is finding enough fuel to enter or exit a massive position without driving the price against themselves. This fuel is liquidity, and without it, the largest engines in the financial world would grind to a halt. To understand how the smart money operates, you must first accept the fundamental law of the marketplace. For every buyer, there must be a seller. And for every seller, there must be a buyer. If a hedge fund wants to buy 50,000 lots of a currency pair, they cannot simply click a button and expect an instantaneous fill at a single price point. If there aren't enough sellers at that level, their very act of buying will force the price to skyrocket, resulting in slippage that eats their profits. Therefore, institutions do not look for patterns. They look for liquidity pools, concentrated areas where a massive number of orders are waiting to be triggered. These liquidity pools are most commonly found where retail traders have been taught to hide, at the obvious support and resistance levels. When you place a stop-loss order just below a swing low, you are essentially telling the market, "I am a willing seller at this price." To an institution looking to buy a massive position, your stop-loss isn't just a safety net. It is the liquidity they need to fill their buy orders. They require a flood of sell orders to match their buy interest, and the most efficient way to find that volume is to drive the price into a cluster of stop losses. This is why you will often see the market sweep a significant high or low before reversing sharply in the opposite direction. It isn't a conspiracy or a glitch. It is the natural mechanics of the market seeking efficiency. The smart money playbook requires you to stop thinking like a participant trying to protect a small position and start thinking like a predator looking for the necessary volume to move a mountain. Once you realize that price is drawn to liquidity like a moth to a flame, the stop hunts that once frustrated you will become the very signals you use to enter the market alongside the giants. Chapter 6. Liquidity, the lifeblood of the markets. To the untrained eye, a sudden break above a long-standing resistance level looks like a breakout, a signal to hit the buy button and ride the momentum. To the institutional giant, however, that move is nothing more than a vacuum cleaner. This is the Judas swing, a deceptive maneuver designed to lure retail traders into the wrong side of the market while simultaneously triggering the stop-loss orders of those already in the trade. In the world of smart money, liquidity isn't just a technical term. It is the fuel required to fill massive orders. Without a pool of sell stops or buy stops to tap into, the big players simply cannot enter or exit their positions without moving the price against themselves. The retail trap begins with the illusion of safety. You are taught to place your protective stops just a few pips behind a swing high or a double bottom, believing these levels act as a floor or ceiling. But professional algorithms are programmed to hunt these exact coordinates. When price aggressively sweeps these levels, it isn't a sign of a new trend, it is a liquidity grab. The market makers are effectively clearing the board, harvesting the capital of smaller participants to build their own inventory. If you've ever experienced the frustration of being stopped out of a trade only to see the market immediately reverse and head toward your original target, you haven't been unlucky. You've been hunted. Learning to identify these sweeps on a price chart requires a shift in perspective. You must stop looking for where to enter and start looking for where others are trapped. A hallmark of the liquidity sweep is the wick, a candle that pushes deep into a structural level but fails to close beyond it, leaving behind a long shadow. This visual cue tells you that the orders have been filled and the trap has been sprung. By waiting for this manipulation to occur before placing your own trade, you transition from being the exit liquidity for a bank to being a partner in their move. In this chapter, we will dissect the anatomy of the stop hunt, teaching you to recognize the false breakout before it empties your account. Chapter 7. engineering liquidity, how the crowd is manipulated. To the untrained eye, a price chart is a chaotic landscape of green and red candles, a jagged mountain range of random fluctuations. But behind the screen, the market is not moved by the scattered trades of retail investors. It is driven by the massive tectonic shifts of central banks, hedge funds, and institutional powerhouses. These giants cannot enter the market with a single click of a mouse. Their liquidity requirements are so immense that they must divide their positions into clusters of orders, leaving behind a distinct structural residue. This residue is what we call an order block, the undeniable footprint of a giant stepping into the arena. An order block is essentially a zone where institutional players have parked their intent. It is often identified as the final candle of a trend before a violent, impulsive move in the opposite direction. When you see a sudden, aggressive expansion in price that breaks market structure, it is rarely a coincidence. It is the result of a massive injection of capital that has cleared out all opposing orders. However, because these institutions operate with such heavy volume, they often leave behind unfilled orders or mitigation requirements. The order block represents the origin of that displacement, acting as a magnet for future price action. Spotting these footprints requires a shift in perspective. You are not looking for support or resistance in the traditional sense. You are looking for evidence of a sponsored move. On a daily time frame, an order block might represent a week-long accumulation phase where the smart money quietly gathered their bags. On a 15-minute chart, it might look like a single bearish candle that preceded a massive bullish breakout. Regardless of the time frame, the logic remains the same. Price must eventually return to these blocks to balance the books and provide the necessary liquidity for the next leg of the journey. To master the smart money playbook, you must learn to ignore the noise and focus on these zones of high probability interest. An order block is not just a box on your chart. It is a historical record of where the giants have committed their capital. When price returns to one of these levels, it isn't just a retest. It is a moment of truth. By identifying these footprints, you stop chasing the market and start waiting for the market to come to you, allowing you to trade in the same direction as the invisible forces that truly move the needle. Chapter 8, The Stop Run, Turning a Loss into a Setup. To the untrained eye, a price chart is a sea of rectangular boxes and candles, each one appearing to hold the promise of a reversal. But in the world of smart money, there is a dangerous trap in assuming that every pause in price action constitutes a valid order block. Institutional players do not leave their footprints everywhere. They leave them only where they have a vested interest in defending a position. If you treat every consolidation zone as a sanctuary for your capital, you aren't trading, you are gambling on noise. The secret to longevity lies in the quality filter, the rigorous set of criteria that separates a high-probability zone of institutional interest from a liquidity trap designed to lure in retail traders. The first hallmark of a valid order block is the displacement that follows its creation. If price languidly drifts away from a zone, it suggests a lack of conviction. However, when you see an explosive, impulsive move that breaks the market structure, you are witnessing the aftermath of true institutional intervention. This is the violent departure. It indicates that the orders resting at that level were so massive that they created a vacuum on the other side. When price eventually wanders back to this origin point, it isn't just a random retracement. It is a return to a scene where big money still has unfinished business. Beyond the move itself, we must examine the why behind the zone's existence. A high-quality filter requires us to look for the displacement of liquidity. Did the candle that formed the block first sweep above a previous high or below a previous low to stop out unsuspecting traders? If the answer is yes, the zone's strength is exponentially higher. This liquidity grab ensures that the institutions have filled their orders by using the forced exits of retail participants as their fuel. A zone that hasn't cleared out the weak hands before the move is often a trap, serving as nothing more than a temporary pause before price continues on to find actual liquidity. Finally, we must consider the internal integrity of the block, specifically the concept of the fair value gap, or imbalance left in its wake. A truly powerful order block doesn't just move price, it leaves a hole in the market, a range of price where only one side of the auction was represented. This imbalance acts as a magnet, pulling price back to the block to rebalance the market. If a zone is immediately retested and filled shortly after its creation, it has often already served its purpose and lost its potency. We are looking for the fresh, untouched zones where the displaced energy remains stored, waiting for the trigger that signals the smart money is ready to defend their ground. Chapter 9: The Equilibrium Code: Premium versus Discount Pricing. In the high-stakes arena of institutional trading, price is never just a number, it is a location. Imagine walking into a high-end department store during a clearance sale versus walking into that same store on the day a new collection drops. The product remains identical, but your relationship to the transaction has fundamentally shifted. This is the essence of the equilibrium code. To master the markets, you must stop viewing the charts as a series of jagged lines and start seeing them as a map subdivided into two distinct territories: the premium and the discount. Without this orientation, you are flying blind, likely overpaying for assets that are about to drop or selling off positions just as the smart money is preparing to buy them back. The mechanism we use to define these zones is the premium versus discount tool, a framework that splits a specific price range exactly in half at the 50% mark, known as equilibrium. Anything trading above this midpoint is considered a premium, expensive and overextended. Anything trading below it is a discount, cheap and undervalued. While retail traders often get swept up in the FOMO of a skyrocketing green candle, the institutional algorithm sees that same move as an opportunity to offload expensive inventory to latecomers. By understanding where these zones lie, you cease to be a gambler reacting to momentum and begin to act like a savvy wholesaler who refuses to pay retail prices. The danger of ignoring this boundary cannot be overstated. If you buy in a premium or sell in a discount, you are inadvertently volunteering to be exit liquidity. This is the cold, hard reality of the financial food chain. For a large bank or hedge fund to close a massive profitable position, they need a counterparty willing to take the other side of the trade at an unfavorable price. If you are hitting the buy button while the price is sitting deep in a premium zone, you are providing the very liquidity the institutions need to take their profits. You become the fuel for their exit, left holding the bag as the market pulls back toward equilibrium. To trade with the smart money, you must adopt their disciplined patience. Your objective is to wait for the market to deliver price into the discount zone before even considering a long position, or into the premium zone before scouting for a short. This shift in mindset transforms your trading from a frantic chase into a strategic ambush. By adhering to the equilibrium code, you ensure that every trade you take is mathematically backed by a favorable location, allowing you to enter the market when the risk is at its lowest and the potential for institutional alignment is at its peak. Chapter 10: Fractal Nature: Aligning the Timeframes. The market is not a chaotic sequence of random movements, but rather a complex repeating pattern known as a fractal. Just as the jagged edge of a coastline looks the same, whether you are viewing it from a satellite or standing on the shore, price action maintains its structural integrity across every conceivable interval. To the untrained eye, a 5-minute chart and a weekly chart might look identical if the axes were hidden. Understanding this fractal nature is the secret to moving from a reactive gambler to a strategic operator. It allows you to see the big picture while operating with the precision of a scalpel, ensuring that your entries are not just guesses, but mathematical alignments of multiple layers of market intent. The most common mistake retail traders make is getting lost in the noise of the lower timeframes without first checking the weather on the higher timeframes. To build a smart money blueprint, you must adopt a top-down approach. Think of the higher timeframe, HTF, as the current of a powerful river. If the daily or weekly trend is bearish, trying to find a long position on a 1-minute chart is like trying to swim upstream against a relentless tide. By establishing the HTF bias first, you define the path of least resistance. You aren't looking for every move. You are looking for the specific moments when the small ripples of the lower time frame begin to flow in the same direction as the great oceanic shifts of the institutional players. Precision is where the top-down approach transforms into a high-performance engine for wealth. Once the HTF provides the narrative, telling you where price is likely to go, the lower time frame LTF provides the execution. This is the art of the zoom in. By reframing a broad HTF zone of interest into a refined LTF entry point, you drastically reduce your risk while exponentially increasing your potential reward. A stop loss that might span 50 pips on a 4-hour chart can often be condensed to 5 pips on a 5-minute chart without changing the ultimate profit target. This synchronization is the cornerstone of high risk-to-reward trading, turning modest market moves into life-changing returns through the power of alignment. Chapter 11, The Power of Time, Trading the Kill Zone's Missions. In the world of high-stakes trading, most beginners obsess over the what, the perfect indicator, the flawless chart pattern, or the magic asset that will change their life. But the market doesn't run on a static loop. It breathes and pulses according to a global clock. Success isn't just about finding the right setup, it's about being present when the institutions are actually moving the needle. If you are hunting for high-probability setups during the midday doldrums, you are effectively trying to sail in a dead calm. To find the wind, you must understand the when. The heartbeat of the financial markets is found within the kill zones, specific windows of time where the world's largest banks and financial institutions inject massive amounts of liquidity into the system. These are not arbitrary hours. They are the moments when the London and New York exchanges overlap and collide. When the opening bell rings in London, the world's largest FX hub wakes up, often setting the direction for the entire day. By the time New York joins the fray a few hours later, the volatility hits a fever pitch. These windows represent the most fertile ground for the smart money to manipulate price, engineer liquidity, and execute their primary objectives. Trading the kill zones requires a fundamental shift in perspective. You must stop viewing the market as a 24-hour casino and start seeing it as a series of tactical missions. During the London kill zone, we often see the Judas swing, a deceptive move designed to trick retail traders into the wrong side of the market before the real trend begins. Understanding this rhythmic deception allows you to stop being the prey and start acting like the predator. You aren't just looking at price action. You are observing a choreographed dance of institutional orders that only happens when the big players are at their desks. As the sun sets on the European session and the New York kill zone takes center stage, the market often experiences a reversal or expansion phase. This is where the day's true narrative is cemented. By aligning your strategy with these specific cycles, you eliminate the noise of the dead hours, where price drifts aimlessly and spreads widen. Mastery of the blueprint isn't about working harder or spending more hours in front of the screen. It's about synchronization. When you trade the kill zones, you aren't just fighting for pips. You are harnessing the raw power of time itself. Chapter 12, Mitigation and Breakers, Handling Trend Shifts. In the high-stakes theater of the financial markets, price action rarely moves in a straight line. It breathes, retreats, and resets. While most retail traders view a sudden trend reversal as a chaotic loss of momentum, the institutional eye sees it as a strategic necessity. At the heart of these shifts lies the concept of mitigation, the process by which smart money participants exit underwater positions without triggering a liquidity crisis. To master the art of the trend shift, you must stop looking at price as a series of random candles and start viewing it as a ledger of liabilities that big players must eventually balance. The mitigation block is the first hidden footprint of this rebalancing act. It occurs when the market fails to create a new high or low, signaling an immediate exhaustion of the prevailing trend. When an institutional firm buys into a declining market only to see price break lower, they are left with trapped buy orders in a sell-side environment. They cannot simply hit the exit button without slipping the market further against themselves. Instead, they wait for price to return to the original point of entry, the mitigation zone, to close those orders at break-even. When you see price return to a failed swing point and sharply reject, you aren't just seeing a technical bounce. You are witnessing the smart money cleaning their books before the next leg of the move. The breaker block, by contrast, is a more aggressive cousin born out of high-velocity stop runs. This pattern is defined by a stop hunt, a move that sweeps liquidity above an old high or below an old low before violently reversing direction. In this scenario, the institutional players intentionally drove price to a specific level to engineer liquidity, only to pivot the market once their larger objectives were met. The breaker is the last up-close or down-close candle before that final sweep. As the market breaks structure, that candle becomes a pivot point where previous support transforms into resistance, or vice versa, with institutional backing. Identifying these blocks allows you to read the true intent of the market behind the screen of volatility. While the novice trader gets frustrated by fakeouts, the practitioner of the smart money blueprint recognizes these as the moments where the largest players are most exposed. By aligning your entries with these mitigation zones and breakers, you are no longer guessing where the trend might go. You are shadowing the giants as they maneuver their capital into the most advantageous positions possible. Mastery of these levels is the difference between being liquidity and providing it. Chapter 13: The Daily Bias. Finding your North Star. To navigate the chaos of the live markets, you must first understand that price does not move in a vacuum. It moves in relation to a specific geographic constant. In the smart money framework, that constant is the opening price. Whether you are looking at the stroke of midnight in New York or the commencement of a new trading week, the opening price serves as the true north of your directional bias. It is the equilibrium point from which all manipulation and expansion begin. Without this anchor, a trader is merely a drifter caught in the noise, but with it, you can begin to see the intentionality behind every wick and candle body. Before the London or New York sessions carve out their respective highs and lows, the market often reveals its hand through the central bank dealer's range, CBDR. This quiet period between 14 and 20 EST acts as the blueprint for the volatility to come. By calculating the standard deviations of this range and observing how price interacts with the daily open, we can distinguish between a genuine trend and a sophisticated trap. If price is trading above the opening price, we are in a premium array where we look for signs of distribution. If it is below, we are in a discount, searching for the accumulation that precedes a bullish run. The power of the daily bias lies in its ability to filter out the Judas swing, that deceptive move at the start of a session designed to engineer liquidity. When you understand that the institutions often push price above the opening price to sell at a higher frequency, you stop chasing the initial impulse and start waiting for the reversal toward your North Star. Your task as a disciplined trader is to wait for the market to move away from the opening price into a logical pool of liquidity, and then hitch a ride on the institutional flow as it seeks its true daily objective. This isn't just a strategy. It is a shift in perspective that transforms the opening bell from a moment of anxiety into a moment of absolute clarity. Chapter 14: Surgical Entries. Precision execution on lower timeframes. In the world of institutional trading, the difference between a retail trader and a professional often comes down to the width of the stop loss. While the amateur is content to set a wide safety net that swallows half their potential profit, the surgical trader understands that the higher time frame is merely a map. The lower time frame is the microscope. Mastering the refinement is not about guessing where the market might turn. It is about waiting for the precise moment when the internal machinery of price delivery shifts in your favor. By zooming in from the macro structure to the micro execution, you transform a vague area of interest into a high-probability kill zone. Imagine a 1-hour order block, OB. On the senior time frame, this looks like a single candle, perhaps representing a 30-pip range. If you enter there, your risk-to-reward ratio is fundamentally capped by the sheer size of your protection. However, as you drop down the time frames, first to the 15-minute, then the 5-minute, and finally the 1-minute, that large block of price action begins to deconstruct. You aren't looking for a new trade. You are looking for the order within the order. You are searching for the specific unmitigated wick or the micro gap where the actual institutional surge originated. This is where the magic of the 5-pip stop loss is born. Precision execution requires a disciplined sequence of confluences. Once price taps into your refined 1-minute zone, you are not clicking buy or sell blindly. You are looking for the signature of a change of character. Hoch. A sudden, aggressive break in the micro-market structure that signals the big players have finally stepped into the ring. This alignment of the 1-minute shift with the 1-hour intent is the hallmark of the smart money approach. It allows you to trade with a heavy position size while maintaining a tight risk profile, turning a standard market move into a career-defining trade. The psychological shift required for this level of surgery is immense. It demands the patience to watch a trade develop for hours on the higher time frame and the nerves to execute on a 1-minute chart where every tick feels magnified. This is not scalping in the traditional sense. It is topographical trading. You are using the lower time frame to confirm that the higher time frame thesis is ready to pay out. When you learn to isolate that single minute of price action that validates the hourly narrative, you stop being a participant in the market and start becoming a predator within it. Chapter 15, The Cycle of Wealth, Accumulation and Distribution. Market movements are rarely the result of chaotic chance. Instead, they are the byproduct of a highly structured rhythmic process choreographed by institutional players. To the untrained eye, price action looks like a jagged mountain range of random peaks and valleys. However, once you understand the cycle of wealth, these movements reveal themselves as a deliberate sequence of orders being filled, shifted, and liquidated. This cycle, popularized by the legendary Richard Wyckoff and refined through the lens of smart money concepts, suggests that the market moves in 4 distinct stages: accumulation, the markup, distribution, and the markdown. By recognizing where price sits within this macro rotation, you stop reacting to the noise and start anticipating the next major expansion. The cornerstone of this institutional delivery is the accumulation, manipulation, and distribution AMD framework. Everything begins with accumulation, a period of lateral price movement where big banks and hedge funds quietly build their positions without tipping their hand or driving the price too high, too fast. This phase is characterized by a range-bound environment that lures retail traders into thinking the market is stagnant. Once the bins are full, the manipulation phase begins. This is the deceptive move, often a sharp spike or a stop run, designed to shake out weak hands and capture final liquidity before the true trend begins. It is the false narrative that traps the masses on the wrong side of the trade, providing the final fuel the institutions need to launch price toward its true destination. As the cycle matures, the market enters the distribution phase, the mirror image of accumulation. Having reached a premium price level, the smart money begins to offload their positions to the latecomers, those who are finally buying in because of the obvious trend. Just as accumulation was the process of quietly buying, distribution is the process of quietly selling into the frenzy of retail demand. Identifying these Wyckofian schematics allows you to see the fingerprints of the market makers. Instead of being the liquidity that gets consumed during the manipulation phase, you learn to wait for the distribution to complete, positioning yourself alongside the giants as the cycle resets and the wealth shifts once again. Chapter 16, The Math of Millions, Scaling Risk and Reward. Most people view the stock market as a sophisticated casino, a place where fortunes are won or lost on the flip of a coin or the whim of a news cycle. They approach their portfolio with the frantic energy of a retail gambler, chasing hot tips and feeling the adrenaline surge with every green candle. But if you step inside the world's most successful hedge funds, you won't find gamblers. You'll find cold, calculating risk managers. To them, trading isn't about being right, it's about the mathematical expectancy of every dollar deployed. The transition from a retail mindset to a professional one begins the moment you stop trying to predict the future and start managing the math of the present. The most dangerous myth in investing is that you need a high win rate to amass a fortune. In reality, some of the wealthiest traders in history have been wrong more often than they were right. The secret lies in the asymmetry of the 1-to-5 risk-reward ratio. When you master this ratio, a measly 30% win rate doesn't just keep you afloat, it makes you a millionaire. If you lose $1,000 on 7 out of 10 trades, but make $5,000 on the remaining 3, you aren't just profitable, you are mathematically unstoppable. Professional scaling is about narrowing your losses until they are microscopic scratches, while allowing your winners the room to grow into giants. Scaling like a professional requires a fundamental shift in how you perceive risk. A retail investor sees a $10,000 loss as a personal failure or a stroke of bad luck. A hedge fund manager sees it as a necessary business expense, a stop-loss cost of doing business to find the next outlier. By treating your capital as a tool rather than an emotional extension of your self-worth, you gain the discipline to cut losers early, a move that feels counterintuitive to the human ego but is essential for survival. This chapter is about stripping away the vanity of being correct and replacing it with the brutal, beautiful efficiency of the math that builds empires. Chapter 17, The Stoic Trader. Managing emotions in institutional chaos. In the high-stakes arena of institutional trading, the most volatile asset you will ever manage isn't Bitcoin or the euro. It is the chemistry of your own nervous system. The trading floor, whether physical or digital, is a theater of engineered chaos designed to provoke the primal instincts of greed and fear. When the chart begins to aggressive print candles away from your desired entry, the brain's amygdala treats the missed opportunity as a physical threat, a loss of resources that must be reclaimed at any cost. This is where most traders experience psychological liquidity, a state where their discipline evaporates and their capital is harvested by the very institutions that waited while they panicked. True mastery in this environment is found in the art of the wait, specifically for the silver bullet setup. This isn't merely a technical pattern, it is a test of stoic resolve. You have identified your high probability order block, you have charted the liquidity voids, and you have set your trap. But the market is under no obligation to be polite. When price aggressively reverses 3 pips ahead of your limit order and rockets toward take profit without you, the sensation of leaving money on the table can be agonizing. In that moment, the phantom profit of a trade you aren't in feels more real than the actual balance in your account. The stoic trader understands that a missed entry is not a failure of the system, but a confirmation of its precision. If the price does not mitigate your order block, the trade simply does not exist. To chase the price as it leaves the station is to enter a transaction based on emotion rather than edge, essentially providing the manual liquidity that institutional algorithms thrive on. Managing institutional chaos requires you to view yourself as an impartial observer of a process, rather than a protagonist in a drama. You are not fighting the market. You are waiting for the market to meet your specific, uncompromising terms. To conquer FOMO, you must internalize the reality that the market is a perpetual motion machine of opportunity. There will always be another silver bullet, another displacement, and another fair value gap. Your edge lies not in your ability to catch every move, but in your ability to remain unmoved when the market doesn't play by your rules. By detaching your ego from the missed trade, you preserve the mental capital necessary to execute the next one perfectly. In the world of smart money, the most profitable move is often the one you had the discipline not to make. Chapter 18, The Filtration System, Quality over Quantity. The professional trader is not a fisherman casting a wide net in hopes of catching anything that swims. Rather, they are a marksman waiting for a single high-probability target to enter the crosshairs. In the world of smart money concepts, the market perennially teems with points of interest, POIs. But the harsh reality is that most of them are traps designed to engineer liquidity for the bigger players. To survive, you must transform your trading desk into a high-grade filtration system. This means moving beyond the ability to simply spot a setup and developing the discipline to discard anything that doesn't meet a rigorous, uncompromising standard of quality. Your no-go list is the most powerful tool in your arsenal, serving as the ultimate gatekeeper for your capital. A common mistake among developing traders is the looks good enough fallacy. entering a trade because the structure is mostly aligned, even if a crucial element is missing. We must flip this script. If a POI lacks a clear liquidity sweep prior to the mitigation, it isn't a zone, it is the liquidity itself. Without the fuel provided by a stop run or a grab of old highs and lows, the market has no momentum to reverse. If there is no sweep, there is no entry. Period. Strict structural alignment follows closely behind liquidity as a non-negotiable filter. You will often see beautiful order blocks or fair value gaps that exist in a vacuum, completely disconnected from the higher timeframe narrative. Trading a bullish 15-minute setup into a bearish 4-hour supply zone is a recipe for heartbreak. Your filtration system must demand a hierarchical agreement. If the macro structural trend is shouting sell, you must have the fortitude to ignore even the most tempting local buy signals. Quality over quantity means being comfortable with the silence of a screen that offers no perfect setups. By utilizing the POI checklist, you shift your psychological burden from "how much can I make" to "is this setup worthy of my risk?" This shift in perspective is what separates the gambler from the professional. When you begin to eliminate setups characterized by dirty price action, unmitigated wick zones, or lack of displacement, you will notice an immediate decline in your trade frequency and a simultaneous surge in your win rate. You are no longer chasing the market. You are waiting for the market to prove its intent to you through a series of specific, filtered requirements. Chapter 19, The Forex Blueprint, Tracking Central Bank Flow. To master the foreign exchange market, you must first stop viewing currencies as isolated assets and start seeing them as the shadow cast by central bank policy. In the realm of smart money concepts, the Forex market is not a random walk of exchange rates. It is a highly choreographed flow of liquidity, orchestrated by institutions that operate on a scale far beyond the retail imagination. While the average trader is distracted by news headlines and lagging indicators, the smart money is busy tracking the divergence between the world's reserve currency and its peers. This is where the blueprint shifts from theory into high-stakes application, focusing on the most liquid corridors in the world, the major pairs. The foundation of any sophisticated Forex strategy begins with the US dollar index, DXY. Think of the DXY as the North Star of the global financial system. Because the euro and the pound sterling are inversely correlated with the dollar, a seasoned practitioner of the smart money blueprint never enters a trade on EUR-USD or GBP-USD without first analyzing the dollar's narrative. When the DXY reaches a key institutional supply zone or a liquidity sweep, the ripple effect across the majors is instantaneous. By aligning your bias with the DXY's directional flow, you aren't just trading a currency pair. You are trading the heartbeat of global capital. Success in this arena requires an intimate understanding of SMT divergence, the smart money tool that reveals when the market is lying to the public. In a healthy trending environment, the DXY and EUR-USD should move in perfect mirror symmetry. When one makes a lower low, the other should make a higher high. When this correlation breaks, when the dollar fails to reach a new high while the euro manages to breach a new low, it signals a massive crack in the trend. This hidden displacement is the footprint of central banks absorbing orders and preparing for a reversal. It is the moment the blueprint reveals its greatest strength, the ability to see the reversal before the rest of the world even realizes the trend has ended. Chapter 20, Indices and Commodities. Faster moves, same logic. If you've spent any amount of time watching a chart of the NASDAQ 100 or crude oil, you know that these markets don't just move. They sprint. While the foreign exchange markets often behave like a rhythmic, steady tide, indices and commodities are more akin to a pressurized steam engine. However, the most critical lesson for any trader transitioning to these assets is that the increased speed does not equate to chaos. The smart money, logic of liquidity sweeps, mitigated order blocks, and market structure shifts remains the bedrock of price action. The difference lies purely in the delivery. The displacements are more violent, the sweeps are deeper, and the rewards for patience are exponentially higher. The heartbeat of the equities market is defined by its specific sessions, most notably the opening drive. When the New York bell rings at 9:30 a.m. EST, the market doesn't just open, It reacts to a massive influx of institutional orders that have been queuing since the pre-market. For an SMC trader, this is not a time to gamble on direction, but a time to hunt for the raid. Often, the market will engineer a lightning-fast run on the previous day's high or low, or perhaps an old 15-minute supply zone, only to reject it instantly. This Judas swing is designed to induce retail traders into chasing the breakout before the real institutional move begins its true expansion in the opposite direction. As the morning volatility subsides, we enter the New York lunch phase, a notorious trap for the undisciplined. Between 12 p.m. and 1:30 p.m. EST, liquidity often dries up as volume drops, leading to choppy, sideways price action that exists solely to engineer new internal range liquidity. This is where most traders surrender their morning profits by overtrading SMC setups that lack the necessary momentum to follow through. Understanding this lull is vital. The smart money isn't active here, so you shouldn't be either. Instead, you use this time to identify the newly formed buy-side and sell-side liquidity pools that will inevitably be targeted during the PM session, silver bullet, or the closing run. Commodities like gold and oil operate with a similar ferocity, but are even more sensitive to the stop run. Because these assets are heavily leveraged and favored by retail trendline traders, the algorithm often pushes price significantly deeper into an order block or past a swing point than you might see in EUR USD. In these markets, you must learn to wait for the secondary confirmation. Letting the market sweep the liquidity, shift the structure, and then return to a fair value gap ensures that you aren't caught in the initial liquidity grab that defines these high volatility environments. The logic remains the same, but your execution must be sharper, recognizing that in the world of indices and commodities, price moves fast, but the footprint left by big money is even larger. Chapter 21, The Data Lab, Backtesting for Institutional Mastery. In the world of high-stakes trading, the most lethal weapon isn't a complex algorithm or a high-speed terminal. It is a refined, intuitive sense for market geometry. This level of mastery is not born in the heat of a live session, but in the quiet, clinical environment of the data lab. To trade like an institution, you must first learn to disassemble the market's movements with the precision of a forensic scientist. Backtesting is not merely a task of verifying a strategy's win rate. It is the process of building deep, subconscious pattern recognition for institutional signatures. You are training your eye to see the invisible, the subtle footprints of smart money that the retail crowd consistently overlooks. True backtesting is the bridge between theoretical knowledge and reflexive execution. Beginners often treat history as a static chart, but a professional treats it as a living rehearsal. As you scroll back through price action, you aren't just looking for where a trade could have been. You are hunting for the why behind every impulse and correction. You are scouting for the mitigation of old orders, the sweeping of liquidity, and the structural shifts that signal big players are entering the fray. By replaying these moments thousands of times, you bypass the analytical delay of the conscious mind. Eventually, when these setups appear in real time, you won't have to think. You will simply recognize. The cornerstone of this institutional mastery is the rigorous collection of data through a professional journal. This is where the subjective experience of trading meets the objective reality of statistics. Every entry in your data lab must capture the narrative of the market, the higher timeframe context, the specific signature of the entry, and the psychological state of the observer. Over time, this data reveals your personal edge, stripping away the noise of ego and desperation. You begin to understand that a losing trade is simply an expensive data point, and a winning trade is the reward for disciplined observation. Success in the markets is a byproduct of how many quality repetitions you have logged when the world was not watching. Chapter 22, Trade Management, Protecting the Bag. The moment you click buy or sell, the game shifts from anticipation to preservation. Execution is merely the price of admission. Trade management is where the professional separates themselves from the gambler. Far too many traders treat an open position like a set-it-and-forget-it lottery ticket, failing to realize that a trade is a living, breathing entity that requires constant calibration. Protecting the bag isn't just about avoiding a loss. It's about the surgical application of logic over emotion as the market fluctuates. Your objective is no longer to be right about the direction, but to ensure that the risk you've assumed remains justified by the unfolding price action. The first line of defense in managing an active trade is the move to break even. This is the de-risking phase, a psychological milestone where you effectively remove the threat of capital loss from the table. However, this must be done with precision, not out of fear. Moving a stop loss to your entry point too early can result in getting wicked out by a minor retracement before the real expansion begins. You must wait for the market to create a new structural level, a higher low in a bullish trend or a lower high in a bearish one, before trailing your stop. Once price has cleared a significant hurdle and established a new base, the original trade thesis is protected, allowing you to trade with the house's money. As price approaches major liquidity pools, those obvious highs or lows where buy and sell stops are clustered, the temptation to hold for a moon bag can be your undoing. This is where you must master the art of the partial take profit. By shaving off a portion of your position at key liquidity draws, you lock in realized gains and lower the emotional stakes of the remaining runner. This strategy ensures that even if the market undergoes a violent reversal, you have already extracted value from the move. You are essentially paying yourself for the work already done. The final stage of trade management is the discipline of the runner. After your initial targets are hit and your risk is entirely removed, the remaining portion of your trade is designed to capture the outsized moves that define a profitable quarter. This is the only time you are truly free to let the market breathe. By resisting the urge to micromanage every tick and instead focusing on the higher timeframe objective, you allow the trend to exhaust itself naturally. Protecting the bag means knowing exactly when to be an aggressive defender of your capital and when to be a patient observer of the market's momentum. Chapter 23: When the Smart Money Fails. Learning from Invalidation. The market is a theater of probabilities, not a gallery of certainties. Even when you have meticulously mapped out the order blocks, identified the liquidity voids, and aligned yourself with the higher time frame trend, the smart money logic will occasionally crumble beneath your feet. To the novice, a failed setup feels like a personal betrayal or a flaw in the system. But to the seasoned practitioner, invalidation is not a defeat. It is a critical data point. In the world of institutional order flow, when a protected level fails to hold, it isn't just a losing trade. It is the market screaming that its underlying narrative has shifted. One of the most potent signals that the institutional tide is turning is SMT divergence. This occurs when correlated assets, such as the EUR-USD and the GBP-USD, fail to mirror each other's price swings at key levels. When one pair breaks to a new high while the other creates a lower high, the smart money is showing its hand by revealing a lack of symmetrical participation. This crack in the correlation is often the first warning sign that your long bias is being invalidated. Instead of stubbornly clinging to a dying trade, the professional trader recognizes this mechanical failure as a signal to step aside, or, more importantly, to prepare for a reversal. The beauty of a failed SMC setup lies in its clarity. When a high-probability bullish order block is sliced through like a hot knife through butter, it transforms instantly into a breaker block. The very zone where buyers were expected to step in has now become a ceiling of supply. By shifting your perspective, you realize that the failure of the initial logic has provided you with the exact location for the next high-probability entry in the opposite direction. The market has effectively cleared the board, trapped the early money, and provided a fresh trail of breadcrumbs for you to follow. Learning to embrace invalidation requires a fundamental shift in ego. You must move from wanting to be right about a trade to wanting to be on the right side of the volume. When the institutional logic fails, it usually means a larger, more powerful force has entered the arena, overriding the previous narrative. Your job is not to fight the wind, but to adjust your sails. By analyzing why a setup failed, whether it was a news-driven liquidity grab or a genuine shift in market structure, you gain more insight into the true intentions of the banks than a winning trade could ever provide. In this game, The smartest thing you can do is listen when the money tells you it's changing its mind. Chapter 24, Scaling Up, from Retail Capital to Institutional Size. The transition from a retail mindset to an institutional reality is not merely a matter of adding zeros to your account balance. It is a fundamental shift in how you perceive risk and execution. Most traders spend their early days fighting for scraps in the retail trenches, trying to turn a few $100s into a fortune through sheer force of will and high-leverage gambles. However, the true power of smart money concepts, SMC, lies in their scalability. When you stop chasing pips and start mastering the mechanics of order flow and institutional liquidity, you begin to see that the same logic governing a $1,000 account applies to a $100,000 or $100,000 allocation. The market is fractal, and your strategy must be as well. Compounding a small retail account is an essential rite of passage, serving as the ultimate testing ground for your emotional discipline. It is here in the micro stakes where you prove you can respect a stop loss when the dollar amount feels insignificant. To scale up, you must treat your small account with the same reverence as a corporate treasury. By focusing on high-probability SMC setups, identifying the mitigation of supply and demand zones, and the clearing of inducement, you develop the technical precision required to handle professional-grade capital. You are not just trading for profit. You are auditing your own performance to prove you are a reliable steward of capital. Once consistency is forged in the fire of the retail market, the gateway to institutional-sized capital opens through the world of modern prop firms. These programs have bridged the gap that once stood between talented individual traders and the massive liquidity of the banking world. Transitioning to a funded account requires a shift from growing an account to managing a fund. In this environment, your objective is no longer to double your money every month, but to adhere to strict drawdown limits and risk parameters that mirror institutional standards. The goal is to leverage your SMC edge across a much larger surface area, allowing 1% gains to translate into life-changing professional income. As you step into this new arena, your psychological constitution becomes your most valuable asset. Trading 6 or 7 figures means that a standard 0.5% risk per trade might represent more money than your previous retail account's entire balance. This is where the technical mastery of institutional footprints, understanding where the big boys are trapped and where they are entering, provides the confidence needed to execute without hesitation. Scaling up is the process of stripping away the emotional weight of the money and replacing it with a clinical focus on the blueprint. You are no longer a retail trader hoping for a win. You are a professional liquidity provider executing a proven institutional model. Chapter 25, The Unending Game. Staying sharp in an evolving market. The pursuit of financial mastery is often mistakenly viewed as a mountain with a definitive peak, a singular point where the climb ends and the view remains static. In reality, the smart money blueprint is not a destination, but a methodology for navigating a landscape that is constantly shifting beneath your feet. Markets are organic, breathing organisms driven by the collective psychology of millions and the calculated maneuvers of institutions. To believe you have finally conquered the charts is the moment you become most vulnerable to them. True success in this arena requires the humility to recognize that while your edge is sharp today, the market's evolution is relentless. Staying sharp means embracing the paradox of being an expert practitioner who maintains the curiosity of a novice. The professional trader never stops being a student of the price. They understand that historical patterns are merely clues, not guarantees. As institutional algorithms become more sophisticated and global liquidity shifts in response to new economic frontiers, your ability to adapt will be your greatest asset. This chapter is about the commitment to that evolution, the daily discipline of reviewing your trades, the courage to discard strategies that no longer serve the current environment, and the stamina to keep pace with an unending game. The SMC lifestyle is ultimately defined by a radical ownership of one's own growth. It is about moving beyond the mechanics of order blocks and liquidity sweeps to master the internal equilibrium required to weather any storm. As you move forward, your roadmap should be paved with consistent refinement. periodic audits of your trading journal, deep dives into emerging macro trends, and a steadfast refusal to succumb to complacency. You have been given the tools to decode the language of money. Now your task is to keep listening as that language evolves. The game never ends, but for those who remain students of the tape, the opportunities are infinite.